myself. I've been working in NatWest and RBS as a business manager, been dealing with businesses for about 12, 13 years. Had experience in free agent, also had experience in Metal as well, which is a challenger bank, and I moved to Swoop, so done a full circle. Shane, do you want to just give yourself a little introduction?
Yeah, thanks, Chris. I'm Shane. I'm working on the UK unsecured team. As you can probably tell from my accent, I am not based in the UK myself. I'm based in Dublin. I have been working with Swoop for almost 5 years and have been working on the UK market for about 12 months now or so. And yeah, basically it's my job to assess your clients' funding options depending on what exactly they're in the market for and trying to find them the best funding solution.
My name's Ron. I am one of the customer success managers here at Swoop, specifically in the Swoop for Advisors channel. But before I joined Swoop, I was head of customer success at Futurely, the cash flow forecasting and reporting tool, which we'll see a bit of later. And then after Futurely was acquired by Sage, I was running teams across Go Proposal, Auto Entry, Business Cloud, Futurely, a bunch of different things. So yeah, advisory, forecasting, those kind of things are sort of my specialty, which yeah, we'll talk through a bit more in a second.
Today, we're just going to go through certain things about managing capital. As Ron says, we're going to be having a look at Futurely. We're also going to be talking about a couple of products that might be useful for some of your clients. So obviously just now is a tough time for being self-employed and running a business. So we're really proactive at Swoop. We want to get the right products out to your clients, help them through the tough times, have safety nets if available, and have a partnership with us so that you can rely on, and then make sure that we can look after your clients as well. So I'll just go over what we can do in Swoop. So it's not just funding that we do, we're a full finance platform. So if you do have clients that are looking for some sort of funding or any sort of finance, there's tons of stuff that we can do. So in terms of Swoop, we give you two platforms. We give you an internal one and we give you a custom branded white label. So within them, you're able to look for different things. So at the top, you're able to look for different loans and funding. When I was in the bank, it just mainly focused on overdrafts, loans and asset finance. Whereas now, if you've got a funding need, it can be broken down into numerous different things. So if someone was looking for £100,000, it can be broken down into asset finance. There could be a working capital need. It can just be a straight up business loan. But there's different ways that you can fund the need depending on what the client is looking for. So just to go through the top, you've got asset finance for cars, vans, machinery. You can also do kit outs for restaurants. You can also have invoice finance and invoice discounting. There's not as expensive as it used to be. There's different products in the market now. You've also got your tax loans, which is something that's quite new. Ron will be focusing on that in a little bit, and Shane will be focusing on that in a bit. So you've got funding for VAT, you've got funding for corporation tax, and you've also got funding for self-assessment. You've got commercial mortgages, so anything from buying a property, buying a bit of land, management buyouts, franchising is something that we can do as well. You've got your business loans, you've got working capital and revolving credit, and you've got merchant cash finance. Over to the right, we've got our very own R&D team. So if your clients are looking at R&D, it's in-house with Swoop, so we can do that from start to finish. We've also got a grant finder within the platform as well. So we'll search national, local, regional, and sector-based. But if there is specific needs that they're looking for example, solar panels and EV chargers, we can definitely have a look at that as well. On the left-hand side, we've got 300 investors that sit on our panel. Everything from family offices to VCs to angel investors. All we need is a pitch deck. Send that over to us. We can have a look and hopefully we can match it with an investor. And at the bottom here, you've got everything from pensions, FX, savings accounts. We can actually do credit scoring and we can actually send you a credit safe report as well. Your clients can submit utility bills and it'll be our job to find them a better rate. And you've got insurance from everything from public liability, you've even got private healthcare, and you've got numerous different bank accounts as well. One thing to really act on that with that is savings accounts. So we can send you the rates each month and we'll be able to look for personal, business, partnerships, limited companies and sole traders. And that ranges from fixed to instant access as well. So if your clients do have a lot of money sitting in an account, just give us an email about how much they're looking to invest and we can tell you the rates that they can get from that as well. So that's the Swoop product offering. Lots of different things, but our main three pillars are if we can help the client, we can make you look really good, and Swoop can turn into a little revenue stream for you as well. I'm going to hand it over to Ron now, who's going to be talking about cash flow support. Over to you, Ron.
Yeah, thanks for joining, guys. So as I mentioned at the top of the call, I started my career working with accountants and advisors in cash flow forecasting, and often the barrier, or kind of the hurdle that we got to when I was having these conversations with advisors, is you'd spend a long time kind of building these beautiful forecasts, having these conversations with clients, and then you'd get to this moment where there was sort of and then what? The what next? What's the actionable step that you take after that? And Futurely, ages ago, partnered with Swoop, because often the answer to that is some kind of sort of either business funding, flexible cash solutions, or some of the savings products and whatnot that you can get in Swoop as well. So long before I actually worked at Swoop, I was working with them on forecasts to sort of turn advisory into something that is actionable. And now I'm on the other side of the fence. I think forecasting is even more a topic of conversation for the advisors that I'm working with, because having the conversations that you need to have with people early and at the right time will impact the outcome of sort of the funding journey that the client's going on, your conversations with them, and generally just kind of how positive that outcome is at the end. So I'm going to share my screen. I have used Futurely for the forecasting that I am doing today. I will say other forecasting tools are available. You can obviously also do any of this in a spreadsheet, often where most people start on their forecasting journey. And I can highlight a couple of tools that you get access to via Swoop that will help with that sort of forecasting, as in how to do it just in a spreadsheet, what numbers to put in, and whatnot. In terms of getting started with the forecast, there's a couple of different ways that you can start. I'd always be looking to do a three-way forecast, so that's including the P&L, the balance sheet, and the cash flow. In Futurely, that's as easy as hitting the 3-year cash flow, choosing when you want to start it. So I've kind of pitched what I've created to show you guys today around a sort of end of year review. Let's plan out the first 6 months of 2026. So I'm going to start my forecast from there. You can obviously start it from scratch, build it up from the beginning. There's multiple different methodologies and whatnot that you can use, that from zero-based accounting through to, putting in number by number exactly what you think is going to happen. For a rough quick sketch, starting from last year's actuals is always a good place to start. Especially easy if you're using a spreadsheet. You can basically copy the numbers from last year's P&L and then apply them to this year's balance sheet and move that forward. The other thing that you can obviously do is if you're working with a forecast that they had last year, start with the budget that they put in place for the year before, and then you can carry that forward, making the tweaks that you need to make. Some forecasting tools such as this have auto predictions that you can use. They're a really good way to start a forecast. Futurely has them, Float has them, like I say, a couple of different tools have auto predictions. A good place to start. They're especially good for you monitoring that short-term cash flow, because they update themselves. I always, whenever you're letting a robot do these sort of things, especially if you're kind of then advising on business critical decisions, I'd always make sure that you are then checking those, adjusting the ones that you don't think are correct, and monitoring it as you go forwards. What I've done here is, like I say, I've created a bit of a sort of pitched it as kind of a end of year review, looking at the first 6 months of 2026. So I've created a really quick dashboard here, something that would get a conversation going with a client. So first page, looking back over the year that you've just gone through, an expense breakdown and a P&L. Moving on to the current state of play, how are they sitting at this point of the year? how are you looking as we move into the new year. A combination here of sort of normal financial insights and then a couple of bits of the lending piece that you can get from your Swoop portal. That's where I've pulled these credit score insights from. Big benefits of using a platform like this. This took me about half an hour to pull together all of this, including the forecast. And also it does mean that these are interactive, so you can drill into the figures as much as you want. And then I moved on to looking at the next year. So for here, I've just built a forecast using last year's actuals, and then inputted some of the sort of future sales and whatnot that we know that are going to come for this organization. So the organization that we're looking at is actually a florist. So over the first couple of months of the year, we're seeing a bit of a downward trend and then picking up in the summer as kind of wedding season starts and whatnot. So what I've been able to illustrate here is kind of an upcoming problem. A great conversation to have in December, alerting them of something that's looking to come up in around April time. And then we need to then pitch the conversation that we're going to have after this. The first step is always to kind of drill deeper into the figures. So if we look at just the monthly figures that we've got here, we're actually not running into hot water. Well, I mean, we are a little bit, but we're not running into really deep hot water until April. However, if we then increase that to a weekly view rather than the monthly, we can see that it's actually much, much earlier in the year that we start running into these problems. So it's probably more around February time that we're going to need another solution to work with. And then what I've been able to do is just forecast three different scenarios of how lending or how getting a bit of a cash injection into this business could help. So this red line is if nothing changes based off of the forecast that we had. This yellow line is if the company borrowed 20K, and then this green line is 25K. And the impact that that has across the next 6 months leading us up to July. This was super easy to do, and by using sort of tech like this, or literally just copy and paste and adjusting the different figures that you've got, you can then adjust the impact that these things are having. So I've, for example, done this just in a quick forecast here. Futurely has a loan calculator, so you can just input the terms of the loan. You see all of the different payments here, and then those can be synced directly into the forecast that you're making. Swoop has a loan calculator as well. So this is part of the portal. You can input the figures and it will tell you exactly what the different payments are going to be. And then you can input those into whichever forecasting software it is that you're using. And because and to make it simpler, obviously, you can then just adjust the different figures there to see the impact of that. Down here, all I've done is illustrate the full cost of the loan. So we've got the monthly cost there, across the total cost and the loan to value figure there. What I've done here is sort of show the two extremes of the different interest rates that we could be looking at for this company. This is kind of an illustration of having these conversations in a timely manner, because right now the business is sitting sort of cash positive. We've not run into any of these issues just yet. If we wait until April, further on down the line, is going to impact the decision of the lenders, impact the affordability of the loan, and affect the rates that the client's going to be able to get. So by just illustrating in both the monthly cost and the overall cost, you can show to the client the impact of making these decisions, and also the value of having that forecast in place and monitoring these things ahead of time. As Chris mentioned, there's lots of different solutions. I've just put two into this pack to show you today. So one of them is obviously sort of the traditional cash injection to see how that affects the business. The other one would be looking at some of the big expenditures that are going out. Obviously, one of the biggest expenditures for most small businesses is going to be their quarterly VAT bill. So what I've done here is I've used the Swoop VAT funding calculator, which is super simple. You just put in what your bill is, your company registration number, and then you can get a quote as quickly as that and find out exactly what the payments is. So I've taken those numbers, I fed that into the forecast, and then just illustrated the difference on the cash flow there. So that dip in February that we've seen, if we spread out that VAT payment, we actually avoid that completely through February and March. So through one forecast and one sort of report pack that we're putting in front of a client, we're illustrating several different solutions to the cash flow issues that we're foreseeing for them. And again, like I say, the impact of doing that ahead of time, decreasing that stress and securing better rates for the clients as well. But yeah, that's about everything that I wanted to run through. Be time for questions at the end on any of this. But yeah, Shane was going to talk a bit more about specifically the tax funding side of things and HMRC and how to navigate those conversations.
Thanks, Emil, Ron. Yep, so basically what I'm going to touch on is three separate things: the HMRC deadlines and penalty impacts, basically seasonal trading dips in cash flow, and then just mitigating the impact of those cash flow pinches. So I'll start off with VAT submissions and penalties. So HMRC has moved towards more of a point-based and interest-heavy system for VAT returns, and I suppose this was brought in April of this year, and the penalties have become a lot more severe. HMRC have sort of moved away from just sending out a single scary letter to warn about late submissions, penalties, and they've moved towards a more compounding model, which can really negatively affect a business's cash flow. So when you're submitting your VAT returns, each late submission earns 1 point. Once you hit a threshold of 4 points, the business is going to be fined £200 for every late, and for every late return thereafter, it incurs another £200 penalty until it's reset. So the late penalties will kick in after between day 15 and 30. So that's sort of the first penalty section. If you pay between 15 and 30 days late, you're going to face a penalty of 3% on the VAT owed. Any payments made within 14 days of the deadline, you won't attract a penalty. Then the second penalty comes on day 30. So if your VAT remains unpaid after the deadline, after 30 days after the deadline, an additional 3% penalty applies. So that'll bring the total to 6% of the original amount owed. After you go past 31 days, you're going to incur a daily penalty. So from day 31 onwards, a daily penalty accrues at an annual interest rate of 10% on the outstanding VAT. And this basically continues to accumulate every day until the debt is settled. If that wasn't scary enough, in addition to all those penalties, HMRC also charges late penalty interest at 8% a year. So that runs from the day after the payment deadline until you pay in full. So this represents a significant increase from the previous regime, where penalties were at 2%, 2%, and 4% respectively. So to put that all into an example, if a business owes £5,000 in VAT, failing to pay for 45 days would result in a 3% penalty on day 15 of £150, another 3% penalty on day 30, which is another £150, plus 15% of daily payments for days 30 to 45. So that's going to cost about £21. Then you've got your 8% annual interest. So that all adds up pretty quickly. Then if we look at, say, self-assessment, those penalties vary depending on how late your return is. So these penalties apply regardless of whether you owe any tax or not. So even if you're 1 day late, it's an immediate £100 penalty, even if you have no tax to pay or the tax has already been paid. If you're 3 months late, daily penalties of £10 per day begin up to a maximum of £900. Then if you're 6 months late, there's an additional penalty of £300 or 5% of the tax due, whichever figure is greater. If you're 12 months late, you're looking at another penalty of £300 or 5%. And then in serious cases, HMRC may charge up to 100% of the tax due. So, for example, if you filed your accounts in, say, your 23, 24 accounts, and you're just 1 day late in February 25, you're facing a £100 penalty. If that remains outstanding until May, you'd accumulate £900 in daily penalties. Plus, then you've got another £100 fine on top of that. So, for your deadlines, then with self-assessment, in the 31st of October, so a few months ago, there's a deadline from HMRC to receive your paper tax return. On the 30th of December of this year, there's online filing deadline. So if you want HMRC to collect the tax you owe, and anything under 3,000, you automatically pay that through your PAYE tax code. We then have 31st of January of next year is your deadline to file your online tax return. It's also the deadline to pay the tax you owe for the year previous. And then, as well as that, it's the deadline for your first payment on your account for the 25-26 tax year. Then July of next year is your deadline for your second payment on your account for the next tax year. Corporation tax is something similar to self-assessment. 1 day late, £100 penalty. 3 day late, another £100 penalty, and similar enough. When you're 6 months late, there's an additional 10% penalty, another 10% penalty when you're 12 months late, plus £500 worth of penalties, which can increase up to £500. And then when a return is actually more than 6 months late for corporation tax, HMRC will issue a tax determination. Basically they estimate of the corporation tax that you owe, and you can't appeal that decision. So you simply just must pay the amount stated on your file, or else you will incur more penalties and interests. And then just in terms of corporation tax in terms of deadlines, you must pay HMRC no later than 9 months and 1 day after you file your accounts. And then, as well as that, for the return deadline, your company tax return, which is your CT600, must be filed with HMRC online within 12 months after the end of the accounting period. So moving on to seasonal dips and seasonal cash flow worries. Obviously, for many UK businesses, particularly in retail, hospitality, manufacturing, around this time of year, things can obviously get very busy with spending of stock, and there can be a lot of cash flow pinches. So post-Christmas hangover, many businesses have a peak in December, but then they face massive self-assessment VAT bills in January. If the December cash is spent on stock or holiday overheads, that can make a HMRC payment pretty scary. As well as that, a lot of UK businesses that have debtors in December tend to be late payers. A lot of people want to hold on to their cash over Christmas just to make sure that they get through the financial year end, and we see a lot of late payments. So anything that's due in December tends to get paid sort of second, third week of January. Then there's obviously the summer lull in B2B sectors. August often sees a sort of a decision-making freeze where clients go on holidays. If a corporation tax deadline falls in September, business may find the liquidity to pay off that tax bill. And then, of course, we've got the stock. We've got stock funding in the sense that stock can be tied up. So seasonal businesses, they'll often have to pay suppliers before their peak starts. So, a lot of retail businesses will start buying stock in August, September for the Christmas rush. That can deplete cash, and if cash flow does reduce, you may be in danger of incurring any penalties for the different types of tax that I've gone through. So with all that being said, looking at mitigating the impact of cash flow pinches, a lot of UK businesses, a lot of accountants may advise their clients to look at a time to pay with a HMRC. However, the time to pay is essentially it is essentially sort of kicking the can down the road with HMRC, in the sense that the business's VAT payments are in a management paid structure. However, the VAT is actually never up to date. So if a business owner mismanages their cash flow during this payment plan, there can be serious repercussions with HMRC. I think really sort of the main takeaway is to just really not annoy HMRC and don't miss any payments. But obviously that can be easier said than done. So a lot of our clients have taken up the opportunity to get VAT loans, where basically they pay back one of our lending partners over a 3-month term. The lending partner pays HMRC straight away. So HMRC is up to date. There's no issue there. And then our clients will pay back our lending partners a monthly installment every month for 3 months. And the good thing is, typically our lending partners will approve that for 12 months. So they've got 4 quarters there where they know they've got a bit of peace of mind just to know that their VAT will be covered. As well as that, any of our VAT loans with our lending partners are going to be completely unsecured once they're under 150k, and they also don't affect any other credit lines. Corporation tax and self-assessment a little bit different. So you can finance these over a 6 to 12 month term, and then again, as well as that, no personal guarantees for a facility of 150k or less. So as Ron pointed out there, if you have a large corporation tax or self-assessment bill due in September, and then you're looking to also buy stock for, say, Christmas or the new year, it might be worth that business financing it over a 6 to 12 month term. Of course, we can always look at a working capital loan. That's your pretty standard term loan. You can get these loans anywhere from, say, 6 months to 60 months, depending on the business's preference and the credit ratings of the business owners. And typically those working capital loans would be secured by a personal guarantee by the majority shareholder or the different directors that are involved in the business. And then finally, what I'll touch on is rolling credit facilities. These are facilities that are becoming more and more popular across the UK SME space. Basically, this allows businesses to have a much larger overdraft than what they'd ever be approved for from, say, a high street bank. So a number of our lending partners, they wouldn't require personal guarantees for this funding. Some will insist on debentures over the business, and actually some are completely unsecured. So where we found a bit of success with rolling credit facilities has been for businesses, particularly in the construction and engineering industry, where cash flow can get quite tight as one project might be finishing, another has already started, and they need to bridge that gap throughout the year. And just given the nature of that business, given the nature of those industries, they have typically in the past struggled to find a suitable cash flow solution. So knowing that you have, say, a rolling credit facility of 100k for cash flow purposes in the background is, again, just really good peace of mind for any business owner. And of course, that rolling credit facility can be put towards making payments to HMRC. So that's it from me. If anyone has any questions on what Ron or I had discussed, just please let us know.
Thanks for that, Shane. Thanks for that, Ron, as well. Really good. And Shane, just a quick one as well. Have you seen the bounce from businesses when they've taken a VAT loan? Has that had that immediate help in the cash flow, so to speak, whereas they're not using the reserves as much and they can just have that rolling VAT facility if ever they do need it?
Yeah, I mean, I had one client last month. They're actually a watch business. So they sell watches through their retail store and online. They had a corporation tax bill. It was only for, I think it was £6,000 or £7,000. They financed it over 12 months simply because that financing that over 12 months basically gave them access to just much more cash flow on day one, which allowed them to buy more stock, which they can then just turn into more profit. You know, if they put down 7,000 to clear the corporation tax on day one, they can't buy as much stock, and turnover obviously doesn't increase, and their cash flow is severely depleted.
Nice. And also, if you've got any clients that are in quite the hard-hitting industries at the moment, like construction, healthcare, retail, manufacturing, there are safety nets available there as well. So revolving credit facilities, they don't need to pay for it if they don't use it. Shane, I know you've had a bit of success with that as well. So yeah, even if you want to send over your clients, just send over the business name and the turnover, and we can have a look behind the scenes to see what they're eligible for without doing a hard credit score. So there's tons of support available that we can offer. It's just we want to help businesses at the end of the day and put the options to you so you can put them to the client, and hopefully we can help them through the next couple of months and longer. Has anybody got any questions at all? Ideal. Perfect stuff. If there's anything that we can answer, if there's any questions, please feel reach out to your customer success manager, or even Shane or Ron, myself, and we'll be happy to answer them. But I wish everyone a Merry Christmas. Hopefully the tax returns aren't too bad for you, and we'll catch you in the new year.